Okay, so welcome everybody. Thanks for having me here on the program. So this is a paper about learning in financial markets, and it's asking whether financial transaction taxes can prevent stock price booms. It's a joint work with a number of people. Albert, who is a long-standing co-author on this line of research, and Sebastian and Johannes, who are PhD students in Mannheim. So you may not have noticed, but in Europe, financial transaction taxes are back on the policy agenda. The EU Commission has proposed that those taxes be introduced actually at the start of 2014. Not all countries have followed, but there are some. France has introduced financial transaction tax on stock market and related transactions of 0.1%, then was disappointed by the tax revenue and has subsequently increased to 0.2%. And Italy also recently started to levy financial market transaction taxes on stock markets. And of course, such tax instruments are prevalent in many other asset markets, most dominantly housing markets. Spain, for example, has levied an 8% transaction tax throughout its boom-bust episode. Germany also levies quite high financial transaction taxes. Okay? So, what are the goals of the EU Commission's policy proposal? Well, somewhat imprecise. In the policy documents, it says they want to discourage financial market transactions which do not contribute to the efficiency of financial markets. Okay, so what we want to ask are these, taxes useful to achieve this goal, and how are we going to assess, what the goal exactly is? Well, efficiency we're going to interpret here in terms of efficiency of stock market prices, okay, and the efficiency of the resulting allocations. Okay, so what we then do is we construct an asset pricing model that quantitatively replicates a number of important facts that we think are relevant for addressing this question. So we have a model that produces stock price volatility roughly of the kind of the amount we observe in the data, including occasional episodes in which stock prices boom and subsequently bust. Okay? And we have a model that also replicates the dynamics of investors' return expectations as we can see them in survey data. And that's actually important because, that aspect of the data you would not get if you were to impose rational expectations. And it's telling you something about the forces that lead to these booms and busts. Okay? And lastly, and that's a key innovation here, we're going to have a model that approximately replicates key moments describing trading volume, which we feel is important if you want to talk about taxing that activity. Okay? And that's a distinguishing feature of the present analysis. Okay? And within this model, we're going to study the financial transaction taxes, linear financial transaction taxes. Okay? So there's a large literature, there's theoretical literature on financial transaction taxes. There's also large literature that's studying transaction costs, which pretty much operate like transaction taxes. And there's a market microstructure literature that looks at financial transaction taxes. So common to all these is that they are not quantitative. Okay, so there's no evaluation as to what the quantitative credibility of those modeling proposals, and of course, are. Okay, it's not clear whether they replicate price volatility in the first place. There's an empirical literature looking at markets where such taxes have been introduced. Coelho is a recent working paper that is looking at the introduction of financial transaction taxes in Italy and France, and they find that these taxes actually increased price volatility. Okay, so most closely related is probably the work by Bus, Dumas, Upala, and Vilkov, or Vilkov et al., if you wish, who are, they have a quantitatively credible description of a model of asset price behavior, stock price behavior, and they study a range of policy instruments, but they don't look at trading behavior implied by the model. Okay, so that's a distinguishing factor. So how does our model look like? Okay, so the key model ingredients that make us replicate these key data moments are: we have a model where everybody is investing rationally. Okay. But where people, investors, hold subjective beliefs about the price process. And this is actually key for replicating survey data, which we have shown in earlier work are strongly inconsistent with the rational expectations hypothesis. In particular, people tend to be very optimistic about subsequent holding period returns when prices are high. But the return predictability regressions tell you that subsequent holding periods returns, as they realized, are particularly low at those periods, okay? Because of mean reversion in the prices. And we're going to have, to model such kind of behavior, we're going to have investors that extrapolate to different degrees past capital gains in the future. In particular, as I'm going to show you in the data, there's evidence in favor that less experienced investors also extrapolate, but react less strongly to the realized capital gains than sort of investors that have less years of experience of investing in the stock market. Okay? So we put this into our model, and we have previously constructed a representative agent model, and we have now this heterogeneous agent model where investors hold different beliefs because they extrapolate to different degrees, and that's going to endogenously give rise to trading behavior. Okay? And then we're going to study trading behavior, and within that setting, we're going to then add the linear financial transaction taxes. So overall, we have set up the model in a way that it gives the financial transaction taxes the best possible chance of delivering beneficial results. So first of all, in our model, all gains from trade are just arising due to subjective belief differences. Okay? So the work of Simsek and others would then suggest, it's a good idea to tax. Okay? We don't believe this is, a realistic description of reality, but we just want to eliminate all potentially beneficial effects from trade so as to bias results in favor of taxing. Okay?
Do you implicitly have some notion of welfare in your mind?
Yeah, we have welfare. Yeah, we can talk about ex-ante welfare. Okay? I'm going to show you welfare. Yeah. So, and then we also abstract, of course, from a large range of other costs that may be associated with the introduction of financial transaction taxes. People invent financial instruments that are not subject to the tax. That's costly. They redirect orders to other exchanges where they can avoid the taxes, and that has, adverse effects on market liquidity and so on. We're going to abstract from all those. And then thirdly, there is, in our model, there's considerable room, at least in principle, for improving the efficiency of prices and allocations. Okay? And this has to do with the fact that the model displays occasional boom-bust dynamics in which temporarily the fundamental shocks can delink the asset price from its fundamental price, quote unquote. Okay? And these boom-bust cycles, as I'm going to show, are going to redistribute large amount of wealth from investors that extrapolate more towards investors that display less extrapolation. So in our data samples, this would be, wealth redistributions from inexperienced towards more experienced investors. Okay? And the reason why these boom-bust cycles sort of come in is that if people extrapolate and see, say, for fundamental reasons, past prices increase, so capital gains, and as a result of that become optimistic, then at least for some period, this optimism is going to result in increased stock demand, okay? And that increased stock demand is going to bid up the current price further, leading to further capital gains that then feed in further optimism, okay? And then this process endogenously comes to an end as the income effect sort of kicks in, okay? So, and in such a setting, financial transaction taxes can be very helpful, okay? Because if you see past price increases and you become optimistic, but now you start taxing people, okay, then you could prevent, at least in principle, that increased demand hitting the market and driving up prices further, okay? So you could prevent that a certain degree of optimism is going to lead to an additional capital gain that then becomes self-reinforcing, okay? So that's the hope. At least at the time we started this project, okay? And, the outcomes are exactly the opposite. So what we find is that financial transactions taxes do not help in reducing asset price volatility. And instead, they increase the likelihood that the economy is going to embark on one of those cycles. And the reason is that, once you impose these taxes, they create a strong lock-in effect. Okay, so you get, because of the taxes, close to your optimal stock holdings, the gains from trade of second order, okay, but once you have a first order linear tax, okay, you don't want to trade unless the price moves a lot, Okay, so that you get these price insensitive demand curves, and that means that it reduces market liquidity. And if you have some infinitesimal small exogenous variation in stock supply or demand that needs to be accommodated, okay, that means that the price needs to move a lot, okay, in order to make these people trade. And that means in a setting where people extrapolate past price movements, you increase effectively the likelihood of starting such a cycle. Okay? So that's the mechanism through which, in this framework, the taxes contribute to increasing the likelihood of the cycle. Okay? Okay, so quantitatively what we find, if you were to impose a 4% financial transaction tax, which is a lot, it's more like something you find in housing markets, you increase the likelihood of a boom occurring by around a third. Okay? Okay, so outline of the talk. So I'm going to present first some facts about stock prices, expectations, and trading volume that you want to match. Then I'm going to present the model, show you the performance of the model in the absence of taxes, and then show the effects of introducing those taxes. Okay, so let's talk about the facts. So okay, so in all subsequent tables, all numbers are things we want to quantitatively replicate later on. Okay, so we start with a basic set of asset pricing facts that we've looked at in our previous work about stock prices. So this is all quarterly and real. Okay, so this is the price of a quarterly dividend, the PD ratio. It's about 140 in post-war data. The standard deviation is very high, it's about half of that value. And the PD ratio is very persistent. That just tells you there are very large and very persistent swings in the PD ratio over time. Okay, so that's characterizing price dynamics in stock markets, US stock markets. That's the quarterly real return, non-standard deviation of returns, and that's the quarterly real return on stocks. Okay, and then there's this fact that if you look at survey data, you're going to find that when prices are high, this is at the time when people expect high holding period returns. Okay, so in the year 2000, when the PD ratio was very high, and people should have expected some sort of mean reversion, according to what actually happened and the patterns that generally emerge. No, they were very optimistic about future holding period returns. Okay, I'm going to show you this. And that's what this is capturing. And these are the standard fundamental driving forces. Okay? And now, what about trading volume? So here's a graph of trading volume. That's the share of turnover. You see a strong trend. So the quarterly turnover went from about 5% in the early 70s to around 50% at the end of the sample. So you get this strong increase, and that's, of course, a lot of, is due to market access and high-frequency trades and so on. So, we have to somehow remove the trend from this picture, okay? A lot of those, of that increase in the trading volume is supposedly a sort of a short-term trading, okay? And we're going to have a quarterly model, and the only thing we can do is to sort of filter this out by time detrending. Okay, so it's the standard in this literature. It's not very satisfactory, but that's what we're going to do. And we're going to look at moments that are going to be robust to different ways of detrending. Okay, but just be aware that there's this underlying trend in trading volume that we're not capturing. Okay?
Just what specific market is that?
This is NYSE and maybe it's S&P 500. Yeah. Okay. Okay. So here are different detrending methods. Linear, that's going to be our baseline. Linear quadratic, HP moving average. Okay. And here are a number of moments about trading volume that are sort of robust to the way you detrend. Okay. The first thing to note is that there is considerable autocorrelation in trading volume. So if trading volume is high this quarter, it tends to be high next quarter. Okay, that's a very robust fact. There is very little correlation, even though it's sometimes claimed in the literature, between trading volume and price level. Okay, so people that claim there to be a strong relationship, they just ignore, forget to detrend, and then because of the general uptrend in prices. In trading volume, you get a strong correlation during your boom period. Okay, but if you remove the trend, there is little left. Okay, and there is a relationship between trading volume and prices, but it's with the absolute price change. Okay, so trade seems to be generally associated with price changes, but has no predictive power for the direction of that change. Okay, so that's what we find here. Okay, so these are the three moments we're going to focus on. And then there is a strong, there's a relationship also between trading volume and cross-sectional dispersion of beliefs, okay, between heterogeneity of belief or investor disagreement. So whatever investor survey you want to look at, there's this positive correlation, weekly positive correlation between the amount of trading volume and the cross-sectional dispersion. And you can do that also by using interquartile ranges to get rid of, sort of outliers. It's going to be robust to that, okay? So that's what we're also going to focus on this moment, okay? And then what about, so that brings us to the last piece. What about now the surveys, okay? So here I've shown you for the UBS survey, which is a representative sample of US investors over an interesting period of time from the 1999 to 2008. You have, the stock price boom up to the years 2000. You have then the subsequent crash to the year 2003 and the recovery. This picture shows you investors' return expectations in terms of quarterly capital gain expectations, actually, quarterly capital gain expectations in real terms, and for different kinds of investors. So you have in the black line would be relatively inexperienced investors that have 0 to 5 years of experience in the market. Okay. What is common, and then the purple line would be the most experienced with about more than 24 years of experience, stock market experience. Okay. So what you see is common to all, these different experience classes is that they tend to be very optimistic about future returns around the year 2000. Okay, so they expect around 3% quarterly returns. That's a 12% real return from capital gain from holding stocks in the year 2000. As the stock market crashed, their return expectations came down to around 0.5% per quarter. So that's about a 2% real return per year. And then subsequently recovered as the market recovered. Okay. Now, what you see is that the most optimistic agents here, the year 2000, tend to be the inexperienced ones. Okay. So this is the 0 to 5 years of experience category, and this is the more than 24 years of experience category. Now, as the market collapses, you see those guys adjusting by more, the inexperienced guys adjusting by more than the more experienced guys. So this already suggests to you, okay, that there seems to be some stronger responsiveness of these return expectations to realize market outcomes, okay? And also subsequently in the recovery, those guys recovered most, which are the most inexperienced, okay? So actually, it's a bit embarrassing, but if you want to write down a simple model that explains those investor expectations, okay? What you can do is you can just write this adaptive completely ad hoc adaptive expectations model that says your expectations, the previous expectation plus some gain times the news value, okay? And then we can estimate that gain parameter for the different experience classes. And what you're going to find is that, the gain is relatively small, it's somewhat below 2% for the most experienced class, and it sort of increases strong, with the experience as you get less experience, okay? And these are all statistically different from 0 at the 1% level, and if you choose them sufficiently apart, they're also statistically significantly different from each other, okay? So here you see that the gain of this class is around, so around 60% higher than of the most experienced. Okay? All right, so we're going to just feed this heterogeneity we're going to endow agents with beliefs such that they're going to approximately update their capital gain expectations according to that equation, and that they're going to have an updating coefficient in line with the empirical one.
Don't the people with 5 years of experience work for the people that have 25 years of experience? So there's some linkage between these people?
So what do you mean their work?
They got 0 to 5 years experience, and they're working in some group.
Oh.
And the group is headed by the guy that has 25 years.
Oh, yeah. So this is not, so to be clear, maybe I wasn't quite clear. This is not financial market participants. These are not fund managers or anything. These are individual investors, okay? So these are private investors, okay, that ultimately hold the market, okay? What is then, at the fund manager level, what sort of reallocations are done at the fund manager level is a different question.
Individual investors.
Yeah, so this is a representative sample of individual investors.
So the 0 to 5 years are what, people at 30 years old or something?
Well, I don't know how old they are, would have to look it up, but they just have been 0 to 5 years in the market, invested in the market. Okay.
They're active investors.
Well, we don't know how active investors they are.
I mean, you take a job and you've got your pension, it's accumulating, it's being invested.
Well, it could be. There's a lot of evidence that there's a lot of portfolio inertia at the individual investor level. Okay, that's true. But we can't see the portfolios exactly of these people. Okay? We can't see it. But to the extent that these people want to buy stocks and it flows into some mutual fund, the mutual fund manager, whatever he may think, has no choice but to ultimately invest it in some asset in the markets. Okay.
So these people are not necessarily buying the market directly; they might be buying.
Yeah, they could buy it through a mutual fund or other vehicles.
And then you're not counting the experience of the mutual fund manager.
No, that's not relevant because for the inflows, whether or not there's an increased demand for those stocks, the mutual fund manager is just getting the money in, and he can maybe allocate it between different stocks. But in target stock market model, he will have to buy some stock.
How does passive investing count if I just buy the index? You buy the Vanguard.
That's perfectly fine. Yeah, that's perfectly fine. That's actually they're all going to buy an index here. Okay? We're not going to have different assets.
But then, what is the fraction? What is the effect of these particular people on the market volatility? Because in the United States, as I understand it, the large, something like 75% of all trading in the New York Stock Exchange is done by either institutions or high-frequency traders, but they're
Sure.
not in your model.
But that doesn't tell you that they're going to determine the aggregate market fluctuation. I mean, we could trade within periods a lot, okay, and net out at the end of the day at zero, okay? So,
No, the point I'm making is that since you're going to use this as the market,
yeah. But these are the ultimate holders of those assets are in the end some
their
private
effect on the trading behavior is very small. They may be very irrational, but their effect on the trading is very small.
Why are you saying in terms of trading volume?
Yeah.
Well, but yeah, okay. So in terms of the volume, they could be very small, but I don't know what is the mapping between volume and price.
Well,
I don't know. You made a conjecture that the more you trade, the more effect you have on the price. I don't know. If at the end of the day you end the position again with zero and you have a lot of intraday trading, have you had a lot of, do you have a lot of effects on day to next day prices? I don't know. Okay, so let me present the model. So here there are capital I investor types of mass mu I that sums to 1. Okay, so these are the investor type. What is a type? A type is, an agent with a certain price belief, so say a different degree of extrapolation. And as a result of that, that agent is going to take different consumption and investment decisions. Okay? And as a result of that, it's going to accumulate different amounts of wealth. Okay? So beliefs, the type is characterized by beliefs and accumulated wealth. So there's a representative agent of each type and solves a standard intertemporal optimization problem. So it's essentially a lookup setup. So it's maximizing consumption, it's choosing consumption to maximize present expected discounted utility. It's a time separable utility function here. And the only non-standard feature is this subjective probability beliefs about future prices. Okay? And there's a standard budget equation. You can invest in stocks, you can consume old stocks, they pay dividends. There's some non-dividend income, some wages. And here comes the financial transaction tax, okay? If you trade, okay, on the market, you're gonna have to, this is the volume of your trade, and we apply to the absolute value of that volume, the tax, the proportional tax tau, okay? So no matter in what direction you trade, you're gonna have to pay that tax, okay? And then there's probably, the tax may be rebated or not, and there's this rebate. Okay, so the PI is the non-standard feature here, and it's a subjective probability measure over all objects that enter the agent's decision problem that the agent takes as givens, okay? So these are the fundamentals, like dividends, wage income, tax rebates, lump sum tax rebates, and also the stock market prices. Okay, so the competitive prices are given to the agent.
So, in the motivation you mentioned that one role the Tau plays is that it redistributes wealth.
No, tau doesn't redistribute wealth. This thing, I'm not saying this is the reason wealth is redistributed. You're going to see what is the reason wealth is going to be redistributed. Okay, so these agents are rational utility maximizers, but they hold potentially subjective beliefs about those objects. In particular, you're going to have subjective beliefs about this object. Okay, so there's a standard dividend growth process. We don't need to talk about. There's a wage income process that co-integrates with dividend growth. Then we're going to assume as a baseline type-specific lump sum rebates of the tax revenue. Okay, but we could also have that tax revenue spent on some public good. Okay, we have an appendix where we sort of look at the robustness. Okay, and then what do agents know? Well, they know the driving processes for dividends and wages. They know the tax rebate function. Okay. But they're going to have subjective price beliefs. Okay, so they're going to have subjective beliefs about how prices evolve. Okay, and we're going to endow agents with a essentially constant gain learning algorithm. And there's a the well-known Moose trick. So agents believe that price growth is composed of a persistent component and a transitory component. Okay, and that this persistent component is going to be time varying. Okay, so this admits for periods in which prices grow at a rate faster than dividends, as well as for periods in which prices grow at a rate slower than dividends. So that, as you see in the data, you can have these persistent run-ups and mean reversions in the price-dividend ratio. Okay, if you don't like that, you could have also an autoregressive coefficient here. Okay, if you don't like that, and add an intercept. Okay. Okay, so obviously, if you observe price growth and you need to decompose into what is persistent and transitory, then this relative variance is going to determine your common gain, and you're going to get, if you do the math, you're going to get an equation that says your subjectively expected now log price growth is your prior expectation plus some gain plus the news value, and then we're going to exactly calibrate those relative variances to get the estimated gains that we had from the survey data. Okay. So that's what we're going to feed into model. Okay, then we have optimal stock demand of agent I is going to be a function that depends on how wealthy you are, how much stocks you have accumulated, what is the price at which you can trade those stocks, what is your wage to dividend income ratio, and then some belief state M, okay, that is characterizing your posterior mean estimate of that underlying unobserved persistent component, okay? And there would in general be also, a posterior variance estimate, but we have assumed that this converges already to the steady state. Okay, then stock market clearing is you're going to just add all the demands by these different investor types, and then you're going to make it equal to 1, and then we're going to add a really tiny stock supply or demand shock that is outside the model, okay? It's just to break potentially indeterminacies of the equilibrium price that's going to arise because of flat demand curves, okay? You could think of this as stock buybacks or new issuances of stock, okay? It's going to be small relative to the amount of outstanding stocks and small relative to the amount of trade, the average amount of equilibrium trade, okay? All right, so okay, one last thing I'm not going to talk about is that, this problem is non-differentiable. Okay, so you have this linear transaction tax. Sorry, this is taking some time. Okay, you have this linear transaction tax, and at the zero trade point, this constraint is not differentiable, and there's a positive probability that you're going to be there. Okay, so we have a trick that we write an alternative differentiable problem, and we can show under what conditions that alternative problem is going to give the solution to this problem. But with this alternative problem, we can work with first order conditions. Okay, and if you're interested in that, you can look it up in the paper. Okay?
Is the allocation without taxes Pareto efficient?
Sorry?
Is the allocation without taxes Pareto efficient?
In subjective terms, yeah. In subjective terms, there's Pareto efficient. Yeah.
There is no externalities this transaction tax is going to limit.
Once you have the tax, it's not going to be anymore, right?
why do you want this? What is this tax supposed to do?
Well, it's going to tax if you go and want to sell or buy.
But even without, so it's always going to reduce welfare in a Pareto. If I think about Pareto.
Well, but we're going to rebate it to these guys. We're going to kill the impact of it. Okay. Well, you're going to see, it's not efficient in objective terms because there's going to be some inefficiencies that arise from the presence of these features. Okay. Okay. So maybe that's the way to think about it. Okay. 10 minutes?
So I thought you have a model.
Okay, I don't have time, sorry, I think I don't have a lot of time.
You have a model of excess volatility.
Yeah.
And you're seeing if the tax is going to kill the excess.
Yes, that's right.
The answer is no.
The answer is no, yeah. Okay, so we calibrate the model. What's that? No, we don't want it, sorry. Okay. So we're going to put in these 5 agent types, and then we're going to use the same, to tie our hands by using the same parameterization as we have in this paper. In particular, the interesting parameters are, risk aversion is 2, okay, fairly low, and the discount factor, the quality one, is this one, okay? And then the other parameters, pretty standard, okay? So here is the US data. This is how well we do. We get a lot of volatility. Actually, we get too much volatility, okay, relative to the data. So we get a very volatile price-dividend ratio. We get it very autocorrelated. You get a lot of return volatility, actually more than you would get in if you have in the data. We get the high return on stocks. We get this positive correlation between expected returns and the price-dividend ratio, okay, as we see in the data. We get very autocorrelated trading volume, roughly in line with the data. We get a little bit too much correlation between the trading volume and the price-dividend ratio. And this is during the booms, there's going to be more trade, okay? And we get this moment right with the price change. And then we get too much correlation between trading volume and belief dispersion, which is due to the fact that belief dispersion is here the only reason to trade, okay? All right, so if you want to go for somewhat lower updating gains, you can do better and you can get the T statistics. So if you reduce a little bit the extrapolation component, you could do better. But we're not doing that, okay? Okay, so now why do we get stock price booms in this economy? So we're going to do an experiment. So fix the beliefs in T at the ergodic mean and now shock the economy with n positive dividend growth shocks, okay? And nothing else. And let's keep increasing n and see what happens, okay? There's no other shock than these n positive dividend growth shocks of 2 standard deviation size, okay? So here's the picture, here's time. The blue line is if you have 0 shocks. Prices would just grow at the rate of dividends, okay? Now if I put one fundamental positive shock in, you get the green line. Prices increase, okay, and then continue increasing roughly at the rate of dividends, okay. You put 2 shocks in, same, you get a larger increase in prices, okay, because dividends are now permanently higher. You put 3 shocks in, nothing big happens, but now you put 4 shocks in, and suddenly, bang, this thing takes off, and you get a huge boom that comes to an endogenous end. It stays up, and it goes down. Okay, so what is happening here? So we have created, through the fundamental shocks, such big realized capital gains that people have become so much more optimistic that they start bidding up prices by so much that the realized price increase exceeds what they previously expected and therefore feeds into itself. Okay, so you get price increases and belief increases feeding into itself. Okay, and the process comes endogenously to an end, as we show in the previous paper for the representative agent, because then income effects start to kick in and you sort of want to consume more once the stock market wealth makes up a larger part of your wealth, okay? And then it returns. So now what is happening across this, now this is the PD ratio, boom-bust cycle in the PD, okay? So here I've shown you the beliefs of 2 types of agents. The high gain, so these are the inexperienced guys, and these are the low gains. So they all see these price increases, okay? And you see they are equally optimistic initially, but as the prices start to increase, the more high gain guys become more optimistic and persistently stay so, okay, for a while. What does that mean, what they do? Well, they want to buy more stocks, okay? And that's what you see. Here you see the trades. These guys which are more optimistic and less experienced, they start buying stocks, okay? And actually they're doing great initially because they jump on the train very early, okay? And the stock price does increase and they make a lot of money, okay? The problem is though that they keep buying. Maybe I'm just gonna minimize it and that's gonna, is this the minimizing button?
Cancel on the right.
Okay, cancel, okay. Okay, so the problem is that they are still more optimistic and they continue buying while prices are high. Okay? And that's the problem because once the boom comes to an end, okay, they have accumulated so much more stocks and the time they start selling, okay, the price has already gone down. Okay? So these guys that extrapolate more initially are doing well, but then keep on doing too much of the same thing. And as a result of that, they lose a lot in terms of welfare. Okay? So in terms of welfare, permanent consumption variation of this single boom bust episode, okay, they lose around 7% of consumption, while the high gain, the low gain types or more experienced investors, they win considerably. Okay?
Just to clarify, the fractions are constant?
Yeah, so there's
20.
constant fraction, a fifth of each. Okay. We can't have this aging process in the model, so we.
And it's not the same that if you take the average of the gains. I mean, is it not equivalent to a representative agent model?
No, because you wouldn't have trade there. Yeah.
Right, but
The pricing behavior is very similar, but the trading you wouldn't have. Okay, so now let's introduce this pricing, the financial transaction taxes. Okay, so now we introduce a 1% and 4% tax. It's not this, the taxes are more in the order of 0.1% and 0.2%, but we choose these levels in order to avoid that our results are driven by numerical imprecisions. Okay, so we choose these somewhat higher tax rates. Okay? And what you see is that, here in the bold numbers is that pretty much everything is, pretty much unaffected, okay? The only really noticeable changes are that you increase the standard deviation of prices and you increase the standard deviation of returns. So this didn't help, so let me try this one.
You turn off the Wi-Fi.
I don't know how, but okay. So you increase the standard deviation of returns, okay? And there's already some indication that booms become more likely because the average price dividend ratio is moving up, okay? So what is happening, okay? The number of booms...
I don't know how to do that.
Hit escape. Hit escape when you cancel this.
Hit escape now.
Escape.
Again, escape.
And then click.
Usually there's a Wi-Fi.
There's settings down.
Yeah, click on the
Yeah,
settings.
settings look good.
Where are settings?
Yeah,
Right,
system
where you
preferences.
were, system preferences.
Do you use a name, George? The silver square.
The square with the gear.
Next
Next
to
to
the
latex.
text. Next to the tech. Left, 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 left.
That one. Now what?
Is there a Mac person who could come up?
Yeah.
Thanks. Okay, thanks. Okay, so what is happening here is shown here. So this is now the stock demand curve in the presence of a tax. Okay? So we have here the PD ratio, the price at which you can trade. And here we have the stock demand for an agent that holds 1 unit of the stock. Okay? And you see that there is this flat region where these agents wouldn't want to trade. Okay? And it's pretty large. So there's this huge area over which the agent finds it not beneficial to trade in the presence of the tax, even though prices move a lot. Okay? And that means, of course, if you have many agents of that kind and things overlap, okay, their demand curves sort of overlap, or sort of they're very few with a steep slope, okay, then even very small exogenous variations in stock supply and demand are going to move you bang bang from this corner to this corner. Okay, and this is going to have, we can illustrate this that now we need fewer shocks. Okay, we need fewer fundamental shocks, only 2 instead of 4, okay, once we impose a tax, to get a boom. Okay, so here you get with 60% likelihood a boom already with 2 fundamental shocks. With 3 fundamental shocks, you basically get all the time a boom. Okay, so the difference here is that we let these small stock supply shocks operate in addition to the fundamental shocks, okay? So these small stock supply shocks then move the economy one way or the other, and then because people extrapolate, that sort of sets in motion the boom. Okay? So, and here I've shown you conditional moments of boom times versus no boom times. A boom is defined thereby as as an episode where the price dividend ratio exceeds a value of 250 and ends below a value of 200. Okay, so at least, and this is pretty robust because these sort of upshooting episodes are very easily discernible in the time series. Okay? So what you see here are conditional moments, and you see as we start levying the tax, the boom becomes less strong, okay, and the standard deviation actually sort of decreases a little bit, so the booms become less pronounced, and also the duration actually shortens a little bit. But what you see is in normal times, the standard deviation of prices increases as you start levying these taxes, okay, and that's going to ultimately is going to lead to an increase in these boom bust episodes. Okay? All right, so before concluding, also in the paper we also look at the contingent taxes that are only levied above a certain level of the price dividend ratio, because that's a natural response to that. And we find that those sort of taxes give rise to problems of non-existence of equilibrium, okay, and they can also give rise to multiplicity. Okay, so I don't think there's these sort of contingent taxes have sort of very desirable properties, but that's not something I can go into. Okay, so we have a model that replicates price volatility, some key features of trading volume, and the sort of behavior of investor expectations. And then within this model, we get these occasional boom bust cycles with significant amounts of wealth redistribution. And if you impose within the setting financial transaction taxes, you worsen the outcome. You increase price volatility, the likelihood of boom bust cycles, and the associated wealth distribution.
Thank you.